Welcome to this week's episode of Jonathan on Money. This is episode number 164. So, one thing I've been feeling recently, and probably something many listeners can relate to, is the feeling of being overwhelmed between work, family life, personal goals, etc. It's just a lot to juggle every day. In particular, there's been, thankfully, a large inflow of new clients and prospects, tons and tons of bills, as everyone can relate to. There's my article and podcast deadlines, graduation celebrations or year-end shows for the kids, doctor appointments, dental exams, and many other things. I'm certainly not complaining, but when life is hectic, the pressure to get things done can feel intense. This week, as I was having these feelings, almost like a sign from God, I was listening to a show or podcast, and the guest referenced a wonderful quote from the legendary tennis player Billie Jean King, which is actually displayed at Arthur Ashe Stadium in Queens. And she said, "Pressure is a privilege." And you know what? It is a privilege to feel the pressure of a busy work life, hectic family life, to pay the bills, to live that life, and the ability to shuttle around from one errand to the next. While it can feel overwhelming at times, it's a huge bracha to be operating at a level where family, clients, and the community depend on you, and you're always super busy. That was helpful perspective for me. Hopefully, listeners can use that perspective as they navigate their own busy lives as well. And by the way, the full phrase by Billie Jean King, which is immortalized on a bronze plaque along the players' walkway to the court at Arthur Ashe Stadium, actually reads, "Pressure is a privilege and champions adjust." And the story behind the quote took place in 2000 while King was serving as the U.S. captain for Fed Cup event in Las Vegas. And at the time, tennis star Lindsay Davenport was struggling during a match and asked King for advice. King wanted to remind her that having the opportunity to perform at the highest level is a unique honor rather than a burden. In other news, don't forget to buy my book, D's for Diversification, ABCs of Personal Finance, which is now available on Amazon or at jonathanonmoney.com. Buying this book is a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live spring webinar series will continue on Thursday, June 18th at 8:30 a.m., featuring yours truly, Jonathan I. Shenkman, President and Chief Investment Officer of ParkBridge Wealth Management, where I'll be discussing mid-year money check-in, the 2026 trends that are impacting your wealth. And this is my last webinar of this spring season, and I'll include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will discuss what should my son do with his bar mitzvah money. Our quote this week is from F. Scott Fitzgerald on how it is never too late. I'll spend the last half of the episode answering listener questions, including are backdoor Roth IRAs immoral? And finally, we'll end with an actual idea to implement your investing life, where we'll discuss the importance of having an investment process in retirement. And with that, let's jump into this week's talking points. So today, I'd like to discuss the question that comes up often in my practice, which is what should my son do with his bar mitzvah money? So every family's circumstances are different, so there's no one size fits all answer. For example, do you plan to cover your son's expenses until he enters the workforce, or are these funds intended to support his discretionary spending in the near term? Are grandparents hoping this money will one day help with college, a wedding, or even a first home? Clarifying the purpose of the funds will help determine how they should be managed. That said, zooming out, receiving a meaningful sum of money at age 13 is more than a financial event. It's actually an educational opportunity. A bar mitzvah marks the transition to responsibility in Jewish life. It is therefore an ideal moment to introduce your son to the responsibilities that accompany money. Done thoughtfully, these gifts can become the foundation of a lifelong financial literacy. Therefore, start by teaching values. Before discussing spending or investing, I would encourage families to begin with a conversation about the importance of prioritizing tzedakah. A bar mitzvah is fundamentally about responsibility and identity. Allocating a portion of his gifts to charity reinforces the idea that financial blessings come with obligations. It teaches gratitude, perspective, and the importance of contributing to something larger than oneself. This does not need to be a perfunctory gesture. Sit down together and discuss which causes matter to him. Perhaps it's a local synagogue, a Jewish education institution, an organization in Israel, or a broader humanitarian cause. Allowing him to research and select the recipient makes the lesson more meaningful. If the first action he takes with his first significant inflow of money is giving, that impression can actually last a lifetime. Next is the structure of this whole thing. What I mean by that is that one of the first practical steps is opening a custodial brokerage account. A custodial account allows a minor to own financial assets such as stocks, bonds, or mutual funds, while an adult manages the account until the child reaches the age of majority. The two most common types of custodial accounts are an UGMA, Uniform Gift to Minors account, and UTMA, Uniform Transfer to Minors Act. While there are technical differences between them, both function similarly for most families. Importantly, contributions to these accounts are irrevocable gifts. Once money is transferred into the account, it legally belongs to the child. A parent or guardian serves as a custodian and manages the investments, but ownership rests with the minor. At either age 18 or 21, depending on state law, the child assumes full control of the account. This reality alone should prompt thoughtful planning. These funds are not a flexible family asset, they are your child's property. Custodial accounts are taxable. Investment income is generally taxed at the child's lower rate, though once earnings exceed certain thresholds, the kiddie tax rules may apply, potentially taxing some income at the parent's higher rate. From an educational perspective, however, the value is enormous. A custodial account transforms abstract lessons about investing into tangible experience. Your son can log in, see his balance, track growth, and begin to understand that money can work for him over time. Next is to be sure to introduce to your son the rule of three. A helpful framework for managing a windfall, particularly for a young teenager, is the rule of three. This concept divides money into three categories: spend, save, and invest. Spend on immediate wants. This portion is for enjoyment in the present, whether it's pizza outings with friends, sports equipment, or a modest purchase he has been eyeing. Allocating a percentage for spending prevents resentment and builds budgeting skills. When a child uses his own money, he begins to understand trade offs. Spend on the activity may mean foregoing another. That awareness is the beginning of financial security. Next, save for short term goals. Savings differ from spending in that they are earmarked for near term goals. Perhaps he wants a new device before summer or plans to attend a special program. Setting aside funds and watching them accumulate fosters patience and discipline. It also reinforces that not every desire needs to be satisfied immediately. And finally, to invest for the long term growth. The investment bucket is where the real opportunity lies. Funds that are not needed for at least 10 years can potentially be invested for growth. While proper management, this portion could form the early foundation of his financial future, whether for a down payment on a home, seed capital for a business, or simply financial cushion as he enters adulthood. By dividing the money intentionally, you strike a balance between present enjoyment and future security. Next, take the time to sit down and review investment options. Once funds are earmarked for investment, the next step is determining how to invest them. Let's discuss some ideas. First, there are certificates of deposit. CDs offer a guaranteed interest rate for a specified term. They are simple and safe, making them easy to understand. They can serve as a helpful introduction to the concept of earning interest. However, because their growth potential is limited, they may not be optimal for long-term wealth building. There are also the popular Israel bonds. Israel bonds function similarly to CDs. You lend money to the state of Israel and receive interest in return. While they may not offer robust long term growth, they provide a meaningful opportunity to align money with values and reinforce communal responsibility. Teaching a child that investing can reflect identity and principles is an important lesson. There are also stocks and stock funds. For long term growth, diversified stock mutual funds or exchange traded funds are generally the most effective tool. Historically, equities have outpaced inflation over extended periods, making them suitable for money that will not be needed for many years. While I typically discourage concentrated bets on individual stocks, owning a small number of recognizable blue chip companies for educational purposes can be beneficial. If your son uses a company's products, owning a small stake in that company can make the concept of corporate ownership real. If your son was gifted stocks from his grandparents, and in my day, I think every child received Disney stock, he can use that stock as the one to track and follow for educational purposes. That said, the bulk of long term funds should typically be invested in diversified funds rather than single company positions. Next, please take the opportunity to explain core concepts: risk and reward, volatility, compound growth, and the importance of time in the market rather than timing the market. All important concepts that need to be explained. You should also teach him responsibility. This may sound bold, but after educating your son on his options, consider giving him meaningful input or even final say on how his funds are allocated within reasonable guardrails. Most 13-year-olds are not fully forward thinking. That may be a surprise to some. That is precisely why this is a teaching moment. If he chooses to spend a large portion immediately, he may later regret having fewer funds available for something more substantial. That lesson learned early with limited consequences can be invaluable. If he chooses to invest diligently, he will observe growth over time. Watching an account balance increase because of disciplined choices reinforces the rewards of patience. True responsibility requires ownership. Shielding children from every mistake delays maturity. Allowing them to make thoughtful, guided decisions fosters accountability, not only in finances, but across life. And just remember, the heart of the matter here is financial education, which I brought up several times. Ultimately, the most important takeaway is not how the money is allocated, but how the process unfolds. Financial literacy begins at home. Children absorb what they consistently see and hear. If money discussions are secretive or stressful, they internalize that tone. If conversations are calm, values driven, and intentional, they learn that money is simply a tool. Involve your son in reviewing account statements, show him how investments fluctuate, explain why markets rise and fall, discuss inflation and the importance of long term thinking. These moments turn routine administrative tasks into meaningful lessons. A bar mitzvah marks the assumption of mitzvot and personal responsibility. Introducing financial stewardship at the same milestone feels particularly fitting. A 13-year-old may understandably be more focused on yeshiva league floor hockey, preparing for exams, or spending time with friends. Yet, the seeds planted now can compound for decades, both financially and intellectually. Receiving money at a young age is not merely a gift, it is an opportunity. Okay, those are the talking points this week. And as a reminder, you can be notified of my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from F. Scott Fitzgerald. For those who don't know, F. Scott Fitzgerald was an American novelist and one of the most celebrated writers of the 20th century. Born in 1896, he became the literary voice of the Roaring Twenties, capturing the glamour, wealth, ambition, and excess of the Jazz Age. He's best known for the novel The Great Gatsby, widely regarded as a classic of American literature. I think I had to read that in high school, but probably didn't. Fitzgerald's work often explored themes of love, social status, the American dream, and disillusionment. Despite periods of great success, he struggled with financial difficulties and alcoholism before his death in 1940 at the age of 44. Fitzgerald once said, "For what it's worth, it's never too late, or in my case, too early to be whoever you want to be. There's no time limit. Start whenever you want. You can change or stay the same. There are no rules to this thing. We can make the best or the worst of it. I hope you make the best of it. I hope you see things that startle you. I hope you feel things you've never felt before. I hope you meet people who have a different point of view. I hope you live a life you're proud of, and if you're not, I hope you have the courage to start over again." And this quote is a beautifully human reminder that life is not linear and identity is not fixed. It gives permission to evolve without shame, to begin again without apology, and to pursue a life that feels authentic rather than predetermined. The quote's power lies in its compassion. You're allowed to change, to be startled, to grow, to meet new perspective, and to start over if the life you're living no longer reflects who you want to be. It reframes reinvention not as a failure, but as courage. In the world of investing, the same principles apply. There is no too late or too early to begin building a financial life you're proud of. You can change strategies, correct past mistakes, and reset your approach at any time. Markets evolve, goals evolve, and your plan can evolve with them. The courage to start over, whether that means reallocating a portfolio, abandoning a fad, or finally committing to a disciplined long term strategy, is often what separates anxious investors from resilient ones. Just as in life, the only real rule is to keep moving forward with intention, curiosity, and the willingness to course correct when needed. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. Okay, First question. Any financial strategies you would recommend with the commie mayor of New York who never held a real job in his life? Sure. Here are some practical suggestions. One, mitigating estate tax on real estate holdings. One asset class that many investors are worried about is New York City real estate, given a myriad of bad policies that may drive real estate values into the toilet, at least temporarily. The good news is, if you are a New York City property owner, you may now want to consider moving these assets out of your state at lower $7,350,000 for 2026. And furthermore, in 2026, the lifetime gift and estate tax exemption is 15 million per individual. Keep in mind that if your assets are currently above these thresholds, the estate tax liability can be quite onerous. Meet with your estate planning attorney to discuss how these lower valuations on your real estate holdings and how you can strategically avoid paying estate tax by utilizing the lower real estate valuations on your property may be a wonderful way to save you and your heirs taxes in the future. Number two, save on income taxes by setting up a home office. Safety concerns in New York may motivate you to set up a home office, which has tax benefits, not to mention the cost of saving from not commuting. The home office tax deduction allows self-employed individuals and certain contractors to deduct expenses related to the business use of your home, and can potentially save them thousands of dollars annually. Number three, move to a more financially sensible location. One of the best financial planning techniques is moving. Deciding to reside in a more cost effective and tax friendly environment can change the trajectory of your financial life. While I don't expect a mass exodus of New York City residents, I do believe that it will be a very smart financial planning move for many. A less friendly environment for both business and practicing Yiddishkeit may be the final push for some families to make the move they've long been considering. Four, redirect charitable contributions to counteract Mamdani's anti-Israel agenda. Trying to convince someone who's blinded by hatred and with a warped sense of reality is a fool's errand. Instead, I'd encourage folks, I should say, to align their charitable dollars with their Zionist values to combat these hateful positions. If you currently give 5% of your tzedakah dollars to Israel, perhaps you should increase that amount to 25%. Looking for causes that are based in New York but support Israel may be particularly worthwhile. The Jews have a 5,000-year history of overcoming adversity and figuring out creative ways to make money. The rise of Comrade Mamdani will not change that. Next question. Is a backdoor Roth IRA immoral because you have too much money to contribute to a Roth IRA due to the regular income phase outs? So it looks like this question was submitted by Comrade Mamdani himself or his deadbeat socialist friend, AOC. No, creative financial planning techniques that are not illegal are fair game. A backdoor Roth IRA is not even a gray area. It may be overrated, but is certainly not immoral by any stretch of the imagination. If Congress no longer finds this strategy acceptable, they will change the rules to make it no longer mutter. I know there's a movement within America now where making money, financial success, and rich people are evil. However, the U.S. is still a capitalistic society with rules. As long as you follow these rules, you may continue to benefit financially from whatever creative strategy you can implement. Don't feel guilty for playing by the rules and benefiting from them. Next question. Which professionals are the worst at managing their money? I didn't conduct a large survey in order to be able to give you a definitive answer. So my answer can only be anecdotal. I'm going to leave athletes and entertainers aside for now because they operate in a world that is so beyond the realm of normalcy that it's basically a different category altogether. And by the way, you can read an article I wrote on financial planning for entertainers and athletes and I wrote it for the National Society of CPAs, which has a journal can be found online. And I also wrote another one for Trusts and Estates magazine back in 2013, I believe. In my experience, when it comes to poor financial decision making, no one could hold a candle to physicians. Granted, I think they are preyed upon by aggressive life insurance salesmen who sell them absurd financial products that they don't need. That's not their fault. They also spend a ton of time in school and training before entering the workforce and don't have much experience with personal finances until much later in life. However, the combination of having a knack for focusing on the wrong things, things they know think they know everything, and general overconfidence leads them to make bad investment decisions, overlook basic financial planning, lose sight of the big picture, and make poorly timed decisions. It's a fiasco. Engineers are not far behind. I'm not trying to make fun. I save my mocking for people in my field who sell access to hot deals, private credit, whole life insurance, and other nerds kite. But when it comes to physicians and money, I just feel bad. Next question. Can ChatGPT solve most of my financial questions? Be honest, it seems like it can solve most questions. Have you actually used ChatGPT more than once? Have you used it to handle complex tasks? It doesn't seem like you did. Sure, ChatGPT is useful. I use AI in lieu of Google for some searches, general research, and other tasks. However, it does not answer all questions well and oftentimes misses key details. I berate ChatGPT, demanding more sensible answers to my questions and more succinct responses. Alas, AI has a mind of its own and doesn't always cop what I'm looking for. Kal v'chomer, AI tools can't assess nonverbal or certain verbal cues that arise when having a conversation with a client about money. This may include discomfort around certain topics, family dynamics, and the fact that certain financial strategies and products work better for different personality types. To answer your question, I think ChatGPT is a great start for doing your own research, but that's really it. You need to either work a lot harder if you are a do it yourself investor or hire competent humans to help you get the answer you need to address your specific financial concerns. Next question. I have a dilemma. I want to rebalance my taxable account, but given the large gains, it still caused a meaningful taxable event. On the other hand, if I don't rebalance, my portfolio become much more heavily weighted in stocks, which will make it riskier. What do you suggest I do? I suggest that you man the heck up and make a decision. Listen, brah, in every area of life, there are trade offs. You can eat a giant piece of cuckoos, but it will be unkind to your waistline. You could putz around in college, but you may have a hard time securing a career to afford yeshiva tuition payments. You can play it safe as a salaried employee, but sacrifice the potentially big monetary gains of taking some career risks and starting your own business. Trade offs are not always about good versus bad. You can have a steak for lunch, but then you can't go to Carvel for dessert. Both prudent decisions, but you need to sacrifice one for the other. In terms of your question, you need to figure out if you're comfortable avoiding paying taxes, but consequently taking more risk within your portfolio that may lead to big losses in a down market. Alternatively, you can pay the taxes every year, but mitigate the risk of blowing up your nest egg. I think rebalancing every year makes sense. It helps keep investors on track to achieve their goals, which is the whole purpose of investing in the first place. My approach is based on 2 decades of experience working with families, but there's no one right approach. You need to figure out what works for you and do that. Sorry, I can't tell you exactly what to do. You have to make your own decisions in life and learn to live with them. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me via email. I love hearing from my listeners. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I would like to end with a timely and actionable idea that listeners can implement to their own financial lives. Today's timely idea is regarding retirement readiness. And before handing in your resignation letter, it's important to in the years leading up to retirement to set up a sensible investment program. At a minimum, all soon to be retirees should implement the following strategies within their investment program, regardless of their level of wealth, in order to achieve their goals and mitigate risk. First, implement a bond tent. A bond tent is a strategy that puts a few years of expense money into high quality short term bonds or cash equivalents to help prepare for retirement. This approach aims to reduce risk and market downturns that may be devastating while an investor begins withdrawing money from their portfolio. Next, please diversify. The market moves in cycles. No one knows what asset class will outperform and which will plummet in value. This is why spreading your investments into multiple areas of the market is always prudent, especially when you are no longer earning an income to replenish your nest egg. Also, be sure to maintain an allocation to equities. In today's world, it is common for retirees to experience a multi-decade retirement. In order to maintain one's standard of living while minimizing the probability of outliving one's funds, having exposure to stocks is imperative. Gone are the days when folks put their entire portfolio in municipal bonds and lived off the interest payments. The market has changed and so has longevity expectations. Utilize stocks to plan accordingly. And finally, this should also be part of your process. Be sure to avoid chasing yield. Keep in mind that risk and return are inextricably linked. If an investment has a high yield, it means it is risky, and piling into only high yielding investments can blow up your portfolio or make it stagnant for years. Instead, I urge investors that are in retirement to pursue a total return approach to generate portfolio income where they can rely on dividends, interest, and capital appreciation. This strategy has the highest probability of allowing folks to achieve their goals and not run out of money and manage risk. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.